Let's go to our call of the day right now. It's Goldman Sachs on the end of the bull market. The firm's top U.S. equity strategist writing to investors, quote, after 11 years, 13% annualized earnings growth and 16% annualized trough to peak appreciation, we believe the S&P 500 bull market will soon end.
And when the S&P was down 18%.
I guess they have some sort of crystal ball there. They're probably feeling pretty good today about this call because part of it's already come true. I guess let's talk about the call on the downside, and then we can get to how they think this is going to turn around. But how much worse do they think this is going to get? We're down 6% right now.
Yeah, I mean, look, Goldman, and for anyone who reads a lot of Goldman research, I don't know if viewers of the program do or not, they always have things kind of in bands, and they have these intermediate targets, right? So in their view, over the next 3 months, the S&P will at some point reach 2450. Then by the end of this year, Goldman expects the S&P will get back to 3200. So they're looking for roughly another 12% decline in the index from current levels, and then for a 30% rally from those levels. Basically, it's all about what, to use the fancy analyst term, all about the second derivative, the rate of change in earnings estimates. So Goldman now thinks we're going to have a 15% decline in corporate earnings during the second quarter, a 12% in the third quarter. Then we're going to return to growth in the fourth quarter. So essentially, their view is that as things get less bad in the second half of 2020, the market will start to react more positively. And I think it's a point worth keeping in mind here, whether this is Goldman's view or any other view that you're taking from any other expert, which is that the market is going to most likely start to react to things that are ahead of what happens in the real world. And I think that is where a lot of the fear comes in as well. Like, what is the market pricing in terms of lockdowns, widespread lockdowns here in the U.S., widespread quarantines here in the U.S., and what would it have to look like here before the market starts to say it can't get any worse? And right now, whatever your daily life disruption is, the market is telling you it's going to get worse before it gets better. Yeah, that's aside from Goldman's call, but that's the general point here in the markets as we watch the sell-off continue to deepen.
But to their point that we're going to come back, this whole idea of, is V-shape or hockey stick or U-shape, what's different here than in 2018 when we went through a pretty quick drawdown as well is waiting on news on the labor market. And we're starting to get little bits and pieces of that, even from Boeing today. And is the rosy picture for the second half, the idea that we're going to be able to kind of snap back from this, that the demand's going to be there later, is that overly optimistic to some point when we're dealing with something that actually might impact jobs?
You got to check your assumptions. It's possible. It depends on how many people are out of work for what length of time and what length the government goes to reimburse businesses, especially small businesses. If we peak in the U.S. in terms of growth of coronavirus outbreaks within the next 2 to 4 weeks, probably manageable. But if this continues on for some time because of neglect of testing in the first place and other factors, then it's difficult to call. I do agree with their assessment that 6 months down the line, we're going to start feeling tailwinds of easy monetary policy, whatever fiscal measures have been enacted. So that will help matters, but we don't know how bad it's going to get. So who knows? And
I think the real challenge here, David Costin and the Equity Strategy Group, they're top down. They're not sector level, industry level analysts. And so they're looking at this and saying, well, right now, based on what's happening in energy, based on what's happening in financials, we would expect to see a 15% drop in earnings during the second quarter, a 12% drop in the third quarter. The challenge, as we mentioned previously with the airlines, and I think a lot of other industries are going to follow suit, you're going to have guidance withdrawn. And so you have all kinds of analysts and strategists, I think by offering a forecast at all, are being optimistic, almost necessarily, right? To say that we could even forecast a 15% drop in earnings is to be more optimistic than I think a lot of local company level situations would allow.
It's really hard to figure out what stock should be priced at right now when you don't know what the E is. It's quite difficult.
And it's kind of the whole we're not what did you guest on, right, yesterday? Or am I just hearing this from other place? We're not, this isn't a price-setting day?
Yes,
right?
we are going through this, we are experiencing this, but it is not a price-setting day. Who was that? It was a remote guest. They're going to tell us.
The problem is, with respect to everybody, it all blurs together when you're in this kind of environment and everything just comes at you so quickly.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.